You walk into the same bank branch you've used for 30 years, you ask to move your own money, and the teller pauses, taps the screen, and tells you there's a hold on it now. Your account, your money, and nobody behind that desk can quite explain why. Here's what I need you to understand in the next few minutes. There is a number sitting in a government file with your name on it, and the moment your yearly income drifts past it, the size of your pension check quietly starts to shrink. Most people never notice until thousands have already slipped away. I spent my whole working life close to that machinery, the forms, the thresholds, the recovery rules, and I watched ordinary, decent people lose money for one reason only. Nobody at that desk is paid to warn them. But there is a single page, a actual Service Canada form with a number printed at the top that can stop the bleeding in its tracks. I'm going to hand it to you before the end of this. And this works even if you are already retired, already collecting, already sure it's far too late to change anything. It is not too late. Stay with me. Let me tell you why I take this so personally. Years back, I sat across from a man at a kitchen table, much like the one you might be near right now. He'd worked 41 years, paid into everything, never missed a beat. He poured 2 cups of coffee and slid a stack of statements across the table, and the top one showed his old age security had dropped by almost $200 a month, and he had no idea it had even happened. He thought there'd been a mistake. There was no mistake. The system had done exactly what it was built to do, and the only mistake was that nobody told him it was coming. I drove home that night angry, and I've stayed a little angry ever since. So let's start with the number, because everything turns on the number. For the 2024 income year, the moment your net income climbs past $90,997, the government begins taking back 15 cents of your old age security for every dollar you earn above that line. They call it the recovery tax. You won't get a letter that says, "We are now reducing your pension." You'll just see a smaller deposit, and most folks shrug and assume that's simply how it works. It isn't simply how it works. It's how it works when nobody shows you where the line is and how to stay under it. And here's the part that catches people sideways. That recovery doesn't even use the money you're living on today. It reaches backward. It looks at the income you reported the year before, and it punishes this year's check for last year's number. So a one-time event, you sold a cottage, you cashed in an RRSP, you took a lump sum, can shrink your pension for a full 12 months after the money is already spent and gone. The clock is already running on most people, and they don't hear it ticking. Now, why am I starting with the bank teller and that hold on your account? Because the two stories are the same story. Banks across Canada have quietly been handed new powers to pause, delay, and refuse transactions on senior accounts dressed up as protecting you from fraud. And in plenty of cases, that protection is real and it's needed. But the side effect nobody mentions is this. The more the bank controls the timing of your own money, the less control you have over those thresholds I just described. The branch will happily hold your transfer for review. The branch will gladly sell you a 5-year GIC. What the branch will never do is sit you down and say, if you take this money out this way, in this month, you'll cross the line and lose a chunk of your pension next year. That conversation isn't on anyone's screen. So you have to be the one who knows. Let me show you the first thing they don't say out loud. When you turn 71, the government forces you to convert your RRSP into a RRF and start pulling money out whether you need it or not. At 71, the minimum you must withdraw is 5.28% of the whole account every single year, and that percentage climbs as you age. Here's the trap. Every dollar you're forced to withdraw counts as income. And income, as we just learned, is the very thing that pushes you toward that $90,000 line and shrinks your pension. So the same government that gives you old age security with one hand is forcing taxable withdrawals with the other that can claw it right back. Most people sleepwalk straight into this. They let the bank set the RRIF to pay out the bare minimum in cash every December like clockwork. And they never ask the one question that matters. Here's the question. Whose age are you using? This is the piece almost nobody at the branch will volunteer. When you set up your RIIF, you are allowed to base the mandatory minimum withdrawal on your spouse's age instead of your own. And if your spouse is younger than you, that lowers the percentage you're forced to pull out every year. Lower forced withdrawal means lower taxable income, means more of your pension stays in your pocket. I've seen this one decision keep a couple under the recovery line for years, but you have to elect it when the RRIF is set up, and almost nobody tells you the option even exists because the form gets filled out fast and the box gets checked the default way. So that's one lever. But it only delays the pressure. It doesn't release it because eventually the withdrawals climb and the line is still sitting there waiting. Which brings me to something bigger, something that can move thousands of dollars a year all on its own. And if you want every one of these tools laid out in one place, the forms, the thresholds, the exact order to use them, I put it all into a resource built specifically for this. It's called the Senior Money Blueprint, and along with the Senior Shield Blueprint, it's available as the Complete Canadian Retirement Field Edition, a single reference you can sit down with at your own table, at your own pace, for $97. Every threshold, every form code, every timing decision we're covering right now is in there, written the way I'd explain it to a friend. You'll find the link in the description at david-ozzie.com. Now let's keep going, because the next piece is the one that moves the most money for the most couples. But, and this is where the floor shifts, pension income splitting and the spousal age RRF trick both assume you've got a spouse and you've got an RRSP and you've got room to plan. What about the money underneath all of that? What about the benefit that millions of lower income seniors are entitled to and never claim, the one with a clock so tight that every month you wait is a month you never get back? Therefore, let's talk about the single most powerful tool a retired couple in this country has, and one of the most quietly underused. It has a date attached to it, and the date matters because it proves this isn't some loophole I dreamed up, it's law. In October of 2006, the federal government announced what it called the Tax Fairness Plan, and it took effect for the 2007 tax year. Buried inside it was a provision called pension income splitting. Here is what it lets you do. If you are receiving eligible pension income, you are allowed to move up to 50% of it onto your spouse's tax return. On paper, in the eyes of the government, that income now belongs partly to them. Why does that matter so much? Because every threshold we've talked about is calculated per person. The recovery line sits at each individual's income. So if one of you is sitting well above that $90,000 line and the other is sitting comfortably below it, shifting income from the high one to the low one can pull the high earner back under the line and rescue old age security that was about to be taken away. Two people, two separate thresholds, and most couples are treating their money like it can only sit on one return. Now here's what makes me shake my head. The mechanics of splitting happen with a single form at tax time, Form T-1032, signed by both of you, filed with your returns. It costs you nothing. It takes one page. And yet year after year, I'd see couples who qualified perfectly and never did it because the person preparing the return ran it the simple way, and the simple way left money on the table. The bank won't raise it. The default won't catch it. You have to ask for it by name. And this is where the floor shifts, pension income splitting, and the spousal age RRIF trick both assume you've got a spouse and you've got an RRSP and you've got room to plan. What about the money underneath all of that? What about the benefit that millions of lower income seniors are entitled to and never claim, the one with a clock so tight that every month you wait is a month you never get back? Let me tell you about the Guaranteed Income Supplement, because this is where the quietest losses happen. The GIS is an extra monthly payment on top of old age security for seniors with lower incomes, and for a single person it can run well over $1,000 a month. It is not taxed. And here is the catch that costs people dearly. In many cases you have to apply, and if you were late discovering you qualified, Service Canada will only pay you back a maximum of 11 months. Not from the day you became eligible. 11 months, full stop. Every month beyond that window is simply gone. I have watched people learn they qualified 2 and 3 years too late, and there was no recovering it. That's the clock at its cruelest. And the GIS has a wrinkle that traps people coming the other way too. It's income tested, just like the recovery tax, which means a single big withdrawal, the kind your bank cheerfully processes without comment, can knock you off the GIS for an entire year. The branch sees a routine transaction, you see your supplement vanish, same screen, two completely different realities. Now, I promised you something, and I want to honor it right here because I know exactly who's been listening to all this thinking, that's lovely for people still planning, but I'm already retired, I'm already collecting, that ship has sailed for me. I built this next part for you specifically. Don't go anywhere. because this is the part that pays. If you are already retired and already drawing your benefits, you still have a live tool sitting right in front of you. And it has to do with how the GIS treats the money you earn. There's an earnings exemption written into the rules, and it's more generous than almost anyone realizes. The first $5,000 you earn from employment or self-employment is fully exempt. It does not reduce your GIS at all. And then on the next $10,000, only half of it counts against you. So a retiree who picks up part-time work, a little consulting, a seasonal job can earn a real amount of money before it meaningfully touches that supplement. People turn down work or hide it or assume every dollar gets clawed away. It doesn't. The rules already protect a chunk of it, and that protection is sitting there unused. But here's the part for the already retired that I really want you to grab onto, because it's the one that feels like magic and it's completely real. Remember how the system looks at last year's income to decide this year's benefits? That works in your favor the moment your income drops. When you fully retire and your employment income falls off a cliff, you do not have to wait a year and a half for the system to catch up. You can tell Service Canada about the drop using an estimate of your current income, and they can recalculate your GIS based on what you're actually living on now, not the big working year numbers still sitting in their file. People leave the supplement unclaimed for a year or more, quietly poorer, simply because they assumed the slow machine couldn't be told to move faster. It can. You just have to know to tell it. And that idea that you can make the system look at the income you have now instead of the income you used to have is the doorway to the one thing I most wanted to give you tonight. This is the page. This is the form I told you about at the start. Here's the situation it solves. Say something pushed your income up in a single year. You sold a property, you took severance, you cashed a big RRSP withdrawal because the bank told you it was time. Next year, the recovery tax kicks in and starts shrinking your old age security based on that one-time spike, even though your real ongoing income has already dropped back down to normal. The default machine will take 15 cents on every dollar over that line month after month for a full year, holding back your pension because of money you no longer have. Most people grit their teeth and wait it out, losing the whole year, and only get it reconciled long after. You don't have to wait it out. There is a Service Canada form called the Statement of Estimated Income. It carries the code ISP 3041, and what it does is let you say to the government, in writing, that high number was a one-time event. Here's what I actually expect to earn this year. Please base my pension on this instead. When you file it and your real income is below that recovery line, they can stop the recovery and restore your full old age security payments. Now, not next spring, not after another tax cycle. Now, the money that was about to drain away 15 cents at a time stays in your account where it belongs. Think about what that means. The man at my kitchen table, the one who lost almost $200 a month and didn't know why his loss came from exactly this. A one-time withdrawal the year before, a recovery tax the year after, and no one ever told him there was a single page that could have shut it off in weeks. That form existed the whole time. The money was slipping away the whole time. The only missing piece was somebody saying the words out loud. So consider this me saying them to you across the same kind of table before it cost you the way it cost him. And once you understand that, the system can be told to look at your real numbers instead of your old ones. Every piece we covered tonight clicks together. The RRIF set to your younger spouse's age to keep your forced withdrawals low. The pension split on Form T1032 to balance income across two separate thresholds. The GIS earnings exemption protecting the first $5,000 and half of the next 10 of anything you earn. The 11-month window, so you never apply a day later than you must. And the estimated income form ISP 3041, standing by for the year a one-time spike would otherwise quietly eat your pension alive. None of these are loopholes. Every one of them is written into the rules. The only secret was that nobody connected them for you. Now, let me bring it back to that bank teller and the hold on your account, because I don't want you to walk away thinking the branch is the enemy. They're not. The people there are mostly kind, and the fraud protections are mostly real. But you have to understand the shape of the thing. The bank screen is built to manage the bank's risk and sell the bank's products. It is not built to watch your thresholds, time your withdrawals, or whisper, wait until January, when waiting until January would save your supplement. That job has no owner inside that building. which means it has to be your job or it doesn't get done, and the cost of it not getting done is measured in pension checks you'll never see. So here's what I'd do this week. If I were sitting where you're sitting, I'd pull my last notice of assessment and find my net income line, and I'd see how close I am to that $90,997 mark. I'd look at how my RRIF withdrawals are set and ask whose age they're based on. If I'm part of a couple, I'd ask whether we've ever actually filed that T1032 split or just assumed we couldn't. If my income dropped recently, I'd call Service Canada about recalculating based on what I earn now. And if a one-time spike is sitting in my file about to shrink my pension, I'd ask specifically about the Statement of Estimated Income by its code ISP 3041, so the person on the phone knows I'm not guessing. You don't need a financial advisor's permission for any of this. You don't need to restart your whole retirement plan. You don't need to move a single dollar today. You need to know where the lines are and which page to reach for, and now you do. That's the whole difference between the man who loses $200 a month and never understands why, and the man who keeps it. It isn't luck, and it isn't a special account. It's knowing the clock is running and refusing to let it run on you. I want to leave you with the feeling I had driving home from that kitchen table all those years ago, but turned right way around. Back then, it was helplessness watching good people lose money they'd earned over a lifetime because the right words came too late. What you should feel right now is the opposite of that. You just took back the timing. You just got handed the page. The desk never slides across the counter. Nothing has to quietly drain away in the dark anymore because you can see it now and you can stop it. You're the kind of person who paid in your whole life and never once expected a handout. You just expected to keep what you actually earned. That's not greedy. That's fair. And fairness in this system goes to the people who know which questions to ask and which form to name. So be one of them and bring someone you love along with you, because the odds are good that somebody at your own table is losing money tonight and doesn't know it yet. Now, I want to hear from you, and I read these. Tell me one thing in the comments. Has your bank ever put a hold on your own money or steered you into a withdrawal or a GIC without ever mentioning what it might do to your pension? Say what happened. Be specific. Other people in this exact situation need to read your story, because your warning might be the thing that saves the next person their $200 a month. And if you believe what you earned over 40 years should never quietly slip away while no one bothers to warn you, then stand with the rest of us who feel the same, the Canadians who have simply decided they will not be shortchanged in silence. Subscribe and stay close, because the next thing I'm going to walk you through is the one withdrawal order, which account to empty first and which to touch last, that can keep you under the recovery line for years longer than the way the bank sets it up by default. Most people do it backward and never find out. I don't want that to be you. I'll see you in the next one. But before you go, let me give you a few more things to put in your pocket, because I'd hate for you to leave with the headline and miss the fine print that makes it work. First, dates. The recovery line I quoted you moves a little every year because it's indexed to inflation. So don't memorize the dollar figure and walk away. Check the current year's threshold each spring when you do your taxes, because the number that mattered last year is not the number that matters now. The mechanic never changes. 15 cents back on every dollar over the line, but the line itself creeps, and you want to be measuring against this year's mark, not a stale one. Second, timing your withdrawals. If a big expense is coming, a new roof, a car, a trip you promised yourself, and you're going to pull it from your RRSP or RRF, think hard about which calendar year you take it in. Splitting one large withdrawal across 2 tax years, a piece in December and a piece in January, can keep each year's income under the line where one combined hit would have blown straight through it. The bank will happily hand you the whole sum in one afternoon. The calendar is yours to control, and almost nobody uses it on purpose. Third, and this is for the couples especially, when one spouse passes, the survivor often gets pushed onto a single tax return with the same household income flowing through one set of thresholds instead of 2. That's the moment pension splitting quietly stops protecting you, and a survivor who was comfortably under the line for years can suddenly find themselves over it. I'm not telling you this to frighten you. I'm telling you because the surviving spouse is the one who most often gets blindsided by a shrinking check at the worst possible time, and knowing it's coming means you can plan for it instead of being ambushed by it. Fourth, keep your paperwork where you can reach it. The one notice of assessment, the RRIF statement, the record of any one-time income event when you call Service Canada about that estimated income form, the conversation goes 10 times faster if you can read them the real numbers off the page. Vague gets you nowhere with that system. Specific gets you results. And fifth, the simplest one of all, don't assume silence means everything is fine. The deposits land, the months roll by, and because nothing arrives in the mail saying we just reduced you, people believe they're getting everything they're owed. That quiet is not proof. That quiet is exactly the condition the whole machine runs on. Once a year, sit down at your table, pull the numbers, and check the lines yourself the way you check a bill you didn't trust. 20 minutes of looking can be worth thousands. That's the discipline that separates the people who keep their money from the people who lose it without ever knowing. Not genius, not luck, just the willingness to look when no one is making you look. So look, mark a date on your calendar to do exactly that, name that form when you call, and refuse to let one more check shrink in the dark. I'll be right here, and I'll see you in the next one.